Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
Hey, we are back.
Welcome back.
What do you think of the new setup? What do you think of the new setup?
New year. I know. Fancy.
I like it. I like this a lot.
Super fancy.
Kind of looks like a news report, ESPN or Saturday Night Live kind of setup. So I'm excited.
There's a lot of people I've talked to that listen to our podcast that have never seen the podcast. Because I'm always like, hey, do you see this or that? And they're like, I don't ever look at you.
Yeah.
And I'm like, oh, okay. So the video cameras, sometimes people don't look at those. They just listen to them.
True. Yeah, all my friends say they listen to me while they're driving to work or to and from work. And I'm like, yeah, we're on YouTube too. Check us out.
Yeah.
Right? See our smiling faces.
Yeah.
So
maybe they're doing it on purpose.
What's that?
Maybe they're doing it on purpose.
Yeah, exactly. Yeah, I have a face for radio, right? What an exciting topic we have today because, wow, 2024 is over. We are here in 2025. And everybody is like, that is over with. But the reason why I'm excited about this is two front. One, I'm currently shopping for investment opportunities. And you know what's on my mind is obviously the mortgage rates.
Yeah.
And if you go back to 2021, they were at a historic lows of 2 to 3%. Remember those times?
Oh, yeah.
Boy, I wish that was now.
Yep.
But now, 2024 was 6.8. And these kind of things weigh on folks, right? And so now you even seen us jump up to 7, and I'm sure you're going to deep dive into where we are today. But mortgage interest rates and all this stuff plays a huge factor into what investors are thinking.
Yeah.
So I want to deep dive into that today on, you think folks are still sitting back on the sideline because of interest rates? Let's also deep dive into, because that plays a huge factor into affordability.
Yeah.
But then also, there is a shortage of inventory too, and there's reasons why. So before we jump into that, what's your thoughts on just interest rates and affordability and how that impacts investor decisions?
I would say I'm glad 2024 is behind us, to be honest. I think, it's been, that was a tough year, right? Like for a lot of reasons, but the most glaring reason really is interest rates. That was like the biggest glaring reason why. But think about it. We had an election, right? Remember like a year before the election, how people were freezing up and saying, I'm going to wait until the election to do X.
That's right.
I'm going to wait, So you had that.
Yeah. And
then you couple that with the fact that, we've had record low supply coming out of COVID, right? So, if you think about it, like think back to, 20, 21, 22. COVID happens, interest rates are near zero.
Yep.
Everybody's either refinancing or buying and moving because they had time, right? And or they needed to expand.
Right.
Or, they had all this equity now and they could sell and move into something, nicer.
Yeah.
So there was just a lot of activity during that period of time and it swallowed up the supply. Housing stock, right? So all the housing stock got swallowed up, and then you now are dealing with the markets that, we're seeing, now finally we started at the end of 24, start to see some breakthroughs in housing stock. But for the most part, 2024 is a theme of like high rates and no stock, which, my 22 years in real estate, never seen it. Never seen that. Like those are the two oddities. Typically, if you would have low supply in a market, you would see that rates were probably pretty favorable too. Historically, but that's just what we've seen.
Yep.
Now, this time it just wasn't that way. So, to your point, I mean, the average fixed rate mortgage in the country last year in 24 was 6.8%.
Yep.
That's almost 3 points higher than the national average just 2 years prior.
Right.
3 full points higher, right? And then, what I think has been funny too is a lot of people have been saying, date the rate and, the rates will come back down. Have you been hearing that one?
Yeah, I have.
Okay.
Wishful thinking, I
Yeah.
think.
I mean, rates are higher now than even that 6.8, because, when I heard all of that, agents, a lot of times were saying that. It was almost like the lenders were telling agents, oh, just date the rate, we'll refinance them later. They were just like either uneducated or coming out of this like hangover from COVID, thinking that rates were going to dip back. But there's really no reason there's like no economic reason why they would. And, so I think it's been interesting, an interesting year, and especially around like affordability. That's probably the the biggest challenge is like interest rates obviously cause people to have higher mortgage payments.
Yep.
And you would think that home prices would come down when affordability gets out of whack. But because there was been no supply, the home prices not only stayed the same, but they went up a little bit.
Right.
So it's like, again, we saw like this anomaly. I mean, it truly was an economic anomaly.
Yeah.
Like we've never seen anything like that before.
Let's talk about that 6.8, because you're never going to, I mean, I won't say never, but 2, 3, that was just a weird year. But wasn't there a time 6.8 was low?
Yeah,
Right?
no, yeah. I mean, not like that since I've been buying real estate, right? But I remember my parents telling me that they, like for their first couple of homes that they purchased, double-digit mortgages.
Exactly.
12 to 15 to 18% wasn't crazy when you were thinking about buying a home.
Right.
But they were buying houses for $50,000, $60,000, right?
Yes.
So now those two things they're not the same, and so I really think that the biggest problem is affordability. That's, rates could be what they are. They could be anything as long as the home price is okay.
Yeah.
And then you can afford it. But, when 30, 40% of your household income is going into your mortgage payment, that's when things start to get tight for people, and that's where we're at. I think the national average last year was 30% of household income was going to their mortgage payment, which, dude, that's a lot.
That is a ton.
That's a lot.
That is a ton.
Yeah.
Ultimately it's a tough market out there.
Yep.
I'm thinking about right now my first time buyers or my first time investors. They're like, this is too hard for me, right? Because one, I think there was some stats out there that said it was an all-time low for first-time buyers last year. I think, in fact, it was 26%, historically 40%.
Yeah.
But folks just can't afford it, right? Yeah. Not only because there's no inventory, but also to your point, the rates are out there. So just for a moment, speak to those first-time investors and buyers for 2025.
Yeah.
Do they sit on the sideline and wait, or what are your thoughts?
Yeah, I mean, I was talking to this team that only focuses specifically on buyers. They don't work with anything else other than buyers. And, they were telling me how many buyers that they've got qualified. And, these people can qualify for a mortgage, right? So it means that like they've got good jobs, they've got, decent savings, what have you, and they can qualify for a mortgage. But the challenge is they can't afford the home prices.
That's right.
Right?
That's right.
So their mortgage payment, let's just use a broad example. Let's say the mortgage, they qualify for a mortgage payment of $3,000 a month.
Yep.
That gets them a $400,000 home. Where are they going to find a $400,000 home, right? And so that's been the challenge is like they just haven't been able to find homes. So it's not like you don't have a pent-up demand of qualified buyers. You do. You've got a bunch of people that are qualified, but they can't actually find anything to buy because the home prices are so high.
Yep.
So it's not just the rate. It's that the home prices are high too. And that's put all of these first-time buyers in a position of going, okay, do I settle for an inferior property or live in an area that I don't want to live in? Or do I just wait and not buy? And I'm going to live like, in a market that I want to live in, and I'm just going to rent it.
Yep.
That's new, again, I mean, my history, I just haven't seen that before where we've had this issue before.
But you know what's so awesome? And I'll flip it by saying this, right? You have one where inventory is low. You got folks on the sideline who's reluctant to sell because they're sitting on so much equity. There's nowhere to go.
Yeah.
But a platform like Easy Street is awesome because you can invest nationwide. Maybe the affordability is not in Phoenix and Arizona, for example, but it is in Georgia. It is in Florida. And I'm just saying those markets just to say them.
Right.
But I'm saying this is where data becomes more and more important when you're making your sound decisions. So I would just say if you are out there listening, don't get caught in your own backyard when it comes to investing. One of the things you've always taught me is the home I live in is not the best investment opportunity.
No.
So just keep that in mind when you're thinking about purchasing and things like that, right?
Yep.
Yeah. Awesome. How about from an institutional buyer standpoint, because rates impact them as well, right? Like what have you been hearing there? Because they're dealing with the same challenges, but I guess institutional and SFR trends are a little bit differently.
Yeah,
right.
For sure. Yeah. I mean, there was the lowest level of activity from institutional investors in 2024 than we've saw since the industry started.
Yeah.
So, again, they're constrained by rates too, right? And they're also constrained by home prices.
That's right.
So, the issue is their cost of capital is too high, and home prices were arguably artificially high. Therefore, people just weren't willing to sell prices, where they're at. And this was also the first time that we saw rents not pace along with home prices. Usually they pace pretty well along with home prices. Like, the cost of a home goes up, the cost to rent that home goes up as well.
Right.
This time around, what we saw is the cost of the home go up and the cost to rent the property stayed the same.
Yep.
And, that was due to affordability. That's the reason they couldn't push rates wasn't because there wasn't, there wasn't people that maybe would pay it. The problem is that they couldn't create enough demand because there's not enough people that could afford it.
That's right.
You're renting a house for $3,000 a month, and let's say that's 30% of your household income. Again, that's tight. You're living tight again, and that's a tough place to live. So it was light. We saw the lightest year in 2024 for institution. We saw a ton of increased supply on the build for rent side, right? And that's where we saw a bunch of new activity was on the build for rent side, and a lot of that, was because if you think about it, build for rent became super, super popular in say 2020, 1920. When it did, it takes like a year to get the entitlements, and then it takes like another year to get permits, and then you start building, right? So a lot of these doors are coming online now, projects that were planned in 2022, 21, stuff like that. So they've got to complete and finish these projects, and that plays a big piece into like the growth factor of SFR, build for rent on that side of things.
Yeah, this build for rent is just booming. I think it's increasing. I think even if you look at statistics, we as folks are just renting more and more every year. I think it's going up 4% every single year. Yep. And so if you're an investor out there playing the long term, maybe your thought process should be built to rent, because that's where everyone is going. There's a huge increase of folks not wanting to buy.
Yeah.
They can't afford it for one, but they just don't want to, right? COVID has changed a lot for folks. And so if you are in that built for rent model, that may just work for you.
Yeah, people have changed their whole thinking on where they want to live now. It used to be like, get married, as soon as you start having kids, go buy a house. That had to be your thing.
That was the plan.
And then you would stay in that house for 30 years, and that would, you pay it off, and that's how you create, some additional wealth. That's just not the case anymore, right? People are not even like, I talk to younger people, and they're not interested in owning their home. They're like, why would I own it? I don't want the maintenance. I don't want to pay the taxes. Property insurance. Like we just saw this in California. We saw it in Florida a few months earlier. Like how expensive these premiums are. They've not just doubled. A lot of areas they've tripled and quadrupled.
Yeah.
the cost, right? So if you're a tenant in those properties, you might pay a little bit more in rent, but you're not going to pay 4x,
Yeah.
right? The landlord is the one that's now, on the hook for that stuff.
Yeah.
Now, the good news is a lot of those people, bought these properties cheaper.
Mm-hmm.
And so, they've got a lot of equity in the asset. But, if you didn't, that's a tough spot, man.
Yeah.
I mean, it's wild times. 2024 was, crazy. I mean, we, in the beginning of the year, as the interest rates started to go up, I thought for sure you would see home prices just start dropping like flies. Right.
Not
But
yet.
then they went up. Home prices went up by like 6% nationally.
Yeah.
Right. And so, that's insane. But I think the end of Q4, what we saw is that we finally started to see those people that needed to sell finally had to just start selling because you can only hold on for so long.
Yep.
And they'd waited, for interest rates to come down so that hopefully they could sell their home for a premium. They couldn't do it,
Yep.
and then now they're listing their homes.
Mm-hmm.
And supply, I think, is where you're going to start to see home prices get pushed back down, and now, when you got a lot of supply in the market, you got to get competitive, right?
Yep.
And so in order to sell your property, you got to get competitive. And, we've seen just, since like October, we've seen a 34% increase in the number of new listings hitting the market nationally,
Yeah.
which is a ton, So now all of a sudden where you used to list your home and have 8 offers on your property in like 2 days, you're lucky to sell it in 4 months right now.
Exactly.
Yeah. And 6 months is the median. So like agents are still feeling pretty good about the fact that they're moving.
Yeah.
And, I think that's a healthy market. We just haven't seen it in so long. It's uncomfortable.
So would you say this is a buyer's market?
I think, yeah. I mean, I listened to, an economist the other day, and they said, finally, we have flipped.
Yes.
And you finally have gotten into a buyer's market. But the
That's
argument was, is it really? I mean, it's a buyer's market from a place of like, you're going to be able to negotiate the price, but you're only going to be able to do so much with your rate. And that's going to put you into a tough spot. Now, more and more supply hits the market, you could start to see, that change the game quite a bit. But, even this week, like we saw the 10-year, drop significantly. Last week was its highest we've ever seen it. This week it drops significantly, like off a cliff, and mortgage rates start to come back down. I don't know. I mean, I just that mortgage rates are driven by the bond market. People have to buy these bonds on the secondary market. That's how this works.
Yep.
If there's no market for those bonds, then interest rates go up or stay the same.
Yep.
And that's the world we've been living in. So unless all of a sudden people want to own, U.S. mortgage-backed securities, and that bond market becomes competitive again, I think you're going to see a world where interest rates are kind of just where they are, and then it's really going to come down to home prices.
Yep.
And, will that supply affect home prices enough to start making things affordable again?
For some families, right, we have to be considerate of how much everything is costing. And so in some cases for families out there, renting is just as expensive as owning.
Yeah.
What do you tell them? Buy or continue to rent? What's Dan's advice there?
Man, I think every case is unique. That's a tough one. I mean, I think it comes down to what you can afford.
Absolutely.
And what's that lifestyle that you want now?
Absolutely. What's important to you?
Yeah, because I mean, I have friends that live, work in, say, Southern California, renting, and own real estate in other markets to get their appreciation in other markets, and they're just renting those properties in those other markets.
That's right.
That's how they live.
That's right.
That could be the new way, right?
Yep.
That could be a really new option, because there are plenty of markets where you can still get a great yield. I mean, you can get it anywhere, really,
That's
right? But it just might not be the neighborhood that you want to live in necessarily. And, you got to find those kind of niche-y opportunities if that's the game you want to play, But the other thing that's not pacing along with it is wages,
Yeah, absolutely.
right? So I mean, wages haven't caught up to home price appreciation,
Yeah,
and that's kind of left everybody going, okay, well, you want to have all these people to pay more for these properties, but who's going to afford them?
yeah,
Right. And at a certain point, it just becomes a break point, and I think we're kind of starting to see the early signs of people going, yeah, I'm not getting any more money. My interest rates are not moving.
right.
And, in order for me to make an offer on your property, I mean, I know you want 500, but in order for me to buy it, I need to be at like 400.
Yeah,
Right. And I think you're going to start to see that correction happen pretty rapidly,
Yeah.
because people that want to sell, or the sellers today, they need to sell.
Yeah.
They got to sell,
yeah.
and so they're gonna have to move off of these numbers and make them affordable, so that people can buy them.
Yeah, I think if you're listening to this episode, I think you should be optimistic as you go into 2025. There's still room to invest. And I think if you hear Dan clearly, what I hear you're saying is continue to put data behind your decision. Where you live may not be where you invest, right? We live here in beautiful Arizona, which we love. Scottsdale, I love Scottsdale, but from an investment lens, that's not the best city to do. But from a lifestyle, I love it. But all my investment opportunities are in Oklahoma. I'm just making this up. So again, Easy Street, this is where we're the best at it, I think. This is where we provide folks with insight and data so they can make sound decisions in markets they don't live in. And I think that's what's awesome. You have an opportunity to continue to invest in markets you actually don't live in. So what does Dan predict for 2025? You got your crystal ball right here, man.
Okay.
Right?
Yeah.
What are you predicting?
We could probably look back on this at the end of the year. We should do an episode where we look back at this.
Yeah. Oh, we're going to play it back. This is what you said in January, Dan. Are you ready?
I'm guessing. This
All
is
right,
a
here we
guess.
go. 2025 predictions. What is it?
Based on what we know today, I think you're going to see that interest rates essentially stabilize, right?
Okay.
I think they're probably a little high right now, but I don't think you're going to see anything below 6%. That's just my 2 cents
Get
on
over
it.
It ain't coming back.
Yeah, I think the numbers, somewhere between 6 and 6.5 is going to be a good favorable rate. I think you're going to continue to see affordability be an issue, right? The new administration that's coming in, one of the challenges, the headwinds that we're going to have to look out for really quickly is the fact that, there's a lot of talk of like adding these additional tariffs. The tariffs have a good and a bad, right? The tariff is a good thing because, we're going to be able to maybe bring some manufacturing back to the country, or, that those that are taking advantage of the country I can't do that anymore as a result.
Yep.
But the challenge is who ends up paying for it is us. Yep. And so if you need the good, you're going to have to pay more for it. So I think like we as a society are just going to have to like be on the lookout for that and be careful of like, reaching, because that the thing during COVID is when home price or everything spiked in pricing, everybody had enough cash to just pay for it.
That's right.
And so they didn't like it, but they paid for it. Now they're not going to have enough cash to just pay for it. Then what happens? Stuff doesn't sell. And that's really what I think what the administration's kind of aiming at, to say, look, let's adjust the price, because when you bring the price down, then I'll worry less about my tariff. You know, and I think that's something to see what's going on. Inventory, I think, is going to continue to creep. I think you're going to keep seeing inventory creeping up across the country in all the markets, and you're going to see a lot of markets where buying activity from a retail perspective is just normalized, and not everybody's going to be just jumping at the opportunities to buy. And therefore, there's going to be some really nice buying opportunities in 25.
Has to be, right? Because you think about, what's interesting? We talked about this a while ago. This is the most equity folks have had, but it also is the most credit card debt that's it. So eventually, folks might have to sell to pay these credit cards off, right? And then become a renter.
Right.
Do you predict that as
yeah,
well?
I mean, we've even seen, in this last week, I've been talking to agents and all whatnot, and what I hear from them is some of them are saying that their sellers now owe more than what their home is worth. Oh. Again. Oh. Right.
Yeah.
And that's interesting, right? I mean, that's an interesting thing that we didn't really expect. But, I look back at a couple of them, and a couple of them were because somebody told them to date the rate. That's
Yeah,
one reason,
that's right.
right? So they reached for the deal just because they wanted to get a property, and the home price didn't appreciate a ton. But, the rates also haven't come down, so they can't refinance it. They're
Yeah.
stuck,
Yeah.
and so those deals, I think, are going to start kicking back
Gotcha.
to the market, and you'll see a lot more of those. But then you had a bunch of people that, had a bunch of equity run up, took out a home equity line, and now they're upside down in their properties too. And, you'll start to see some of that stuff hit the market here, I think, pretty quickly. So by Q2, I think you start to see a very significant shift in normalization of, affordability.
Yeah.
And it's
Yeah.
just got to come down because nobody is talking about wages. Just across the board, wages are going up by 15%. Like that's not happening. So how are we going to get there?
Yeah.
How are we going to get there?
One thing I'm looking forward to see what happens with syndication in 2025
Yeah.
and fractional ownership. You got any predictions there on, do you think more investors will get into this fractional ownership
Yeah.
as a way of staying, I don't need to come with so much equity or capital,
Yeah.
or even syndication opportunities? What are your predictions there for 2025?
Yeah, from an investor standpoint, I think, some of these, like you mentioned, the build for rent opportunities, I think there's great opportunity in build for rent, if you're looking to syndicate. But even like, the fractional ownership idea of like, I saw a model the other day, and I can't think of the name of the business. I'll think of it in a bit. But what they did is like, instead of you having to come up with 20% down to purchase your home, you would come up with 10% down.
Okay.
They would come up with the additional 10%, and you guys own the house together. So instead of you owning 100% of your house,
Oh, wow.
you own like a fraction of that
Wow.
house from an equity standpoint,
Yeah.
right? But except they don't ride the down, they only ride the up.
Yeah.
And I was like, okay, well, I could see some people that would want to do that,
Yeah.
and just say, hey, look, I'll get 50% of my equity versus none, but I get to be in the house. And, if this thing goes sideways, then I'm going to be on the hook for the whole thing. I mean, that's just how the model worked.
Yeah.
And I could see some opportunity there for some people that maybe are stuck where they can't buy. They're just
Yeah.
stuck in a spot where they can't buy. And this could be a great option for them.
I love that. That's what's fascinating about how resilient we are. Something happens, a new business starts, a new model. Like there's always a way to survive. I remember just COVID alone introduced all these new companies, and here we are, affordability issues, lack of inventory, and then there's all these creative financing ways to help you stay in real estate. In fact, I even saw one the other day where you can invest just $50,000 into this builder. He or she will build the home. You don't own anything. You don't move in, but you just invest in real estate that they can build and sell. I thought it was fascinating. So more to come on that. But hey, 2025, this should be a big year for some folks. And again, get creative, get fractional ownership, syndication, stay close to Easy Street offers, stay close to data and insights. And again, I think if anything, you don't always have to invest where you stay and where you live. But I don't know, Dan, what are your thoughts? You want to wrap this session up with 2025?
Yeah. I think you just gotta, go into the year eyes wide open and take it day by day. Honestly, there's just a lot of volatility at the moment, so just keep your eye on the ball. And there's money to be made in all market cycles. So whether the market's tracking up and the market's tracking down, there's money to be made in all those markets. But I think in order to make the money, you got to be like somewhat ahead of the curve and, bet on trends and bet on like where things are headed versus like your gut. If your gut says, this guy sold his house 6 months ago for this number, I almost like take all of that data and I just like throw it out the window.
That's right.
I'm looking forwards and I go, but this house today didn't sell. And it's not selling because of the price. I have to assume that, they're going to do 1 or 2 price reductions before it does sell. This is really in the new market for that area. This is the new price for that neighborhood. And I think that's where you've got to start, so the old veterans will come out of this because they all know that trick. And it's important. So, link up with those people and, let them show you how they're starting to comp houses. Let them show you how they're thinking about valuations. And then, where this is where investments thrive. I mean, we thrive in a declining market. That's where opportunity sits.
That's right.
So, be eyes wide open and looking for those unique opportunities for cash flow and all kinds of things throughout the year. And I think you'll be awesome. It's going to be a good year.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.